The first question I had was to just share with the students the overall impact of COVID on the real estate market in your particular venue of the market, and kind of tell us what's happening and how people are responding. And again, we'll start with Mark.
Sure, that's a big question, so I'll try to be quick because that's nuanced. But just as a reminder, so I'm on the capital markets side of Jones Lang LaSalle. I lead the Denver office, so debt, equity, investment sales, all product types. So generally, our world has come to a crashing halt like most people. But I think what's really important for people on this call to understand is, from a capital markets perspective, we went into this with the largest amount of capital allocated to real estate in the history of our business. So we had tremendous amount of equity. We had tremendous amount of debt markets. We had great functioning markets. And so this is very different than the GFC, which was caused by financial situation. This was caused, as we all know, by a pandemic. And so it's a very important situation, I think, to distinguish between the two, because everyone's trying to draw between the two. So number one, we went in a very healthy way from a capital market standpoint. Number two, I would tell you the government reacted much quicker in this particular situation than they did in the GFC, which has already led to a revitalization on the debt side of our business. So the debt side of our business, week over week, over the last 3 weeks, has doubled. So we are already seeing an increase in the debt markets come back to commercial real estate, and the debt markets are going to lead us out of this. So I think, look, a lot of things that were broke before this they're just going to end quicker. There's great examples of that. Department stores that were already broke are going to be broke. Malls that were already broke are going to be broke. Companies like a WeWork that probably is going to be broke through this. But there's a lot of positives to come out of this, and we're seeing green shoots in certain areas. So again, our business is down. This is public, 70%, give or take, over the last 90 days. We think it'll stay down for a good portion of this year. But I would tell you, as a firm, we are optimistic that we will start to see some level of recovery towards the fourth quarter and into 2021. So I'll pause there because I'm sure other people have more interesting things to say.
Oh, Barbara, you're on
I
mute.
got it. I caught it. Hey, Chad. So what's your perspective?
Great. So just very briefly about McQuinney. We're based in Denver. We work in 25 markets across the country, and we're diversified by product type. So we'll start with hotels. Between Sage and McQuinney, we had to close almost 75 hotels, which was painful. However, as of the last week or two, we've started reopening all of those hotels, and we actually had some hotels this weekend running over 80% occupancy. Apartments tend to be doing fine. We're giving some concessions, but people are paying about 95%. Industrial is great, and most of our land is very lowly levered and fine there. I will say that I've been in business 30 years now, and for the students that are out there, some of our best investing opportunities always come from economic corrections. I started in May of 1991, and from 91 to 94 during the S&L crisis, and then obviously from 2008 to 2011, just incredible buying opportunities that we can look back on today, and probably half of the net equity in the company came from investing that we did during those periods. And so there's a saying that we use at McQuinney: don't wait for the storm to end. We shall learn how to dance in the rain. This is going to be a great opportunity for acquiring hotels. We consider ourselves a real estate investment company that does development, and we also do acquisitions. And so we have made a lot of offers. Actually just won our first deal a couple days ago to acquire a hotel, and we think there's more that will come. And just like the speaker, Mark, before me said, this is very different than 08 to 010, where you really had a significant pullback in credit. What you had happen here was clearly a pandemic, a shock to the system. And you're having the opposite happen right now, where you're having the basically entire global financial community put a lot of stimulus towards this, which potentially could create problems down the road. But we're still very bullish on real estate. 70% of our portfolio is long-term fixed rate debt, so we don't have a lot of debt maturities. And there's always opportunities in the real estate market. The key is to focus long-term, make sure that you don't have a lot of debt coming due at any particular time, and continue to focus on your vision. And that's what we're doing at McQuinn.
Very, very good. All right, Brian, what's things look like for you, both in the East Coast in New York and across the country?
Well, thanks for having me. So obviously, Newmark is in 90 countries. We focus on a lot of different parts of the market, whether it's debt, equity, representing landlords, representing tenants, working on the project management side. And so we've had a lot of lessons that we've learned as other countries have shut down in terms of what has happened, what the endpoints look like. I think that where our industry or our business has changed in the short term is we've truly become advisors and holding a lot of hands in this process. So I think most people in the real estate market, whether it's been landlords, tenants, lenders, are looking for information. And we really have become more of a disseminator of information in real time of what's going on within the marketplace. Incrementally, there seems to be a new issue du jour every week, whether it's, force majeure clauses and leases in the beginning and, defaults by landlord, defaults by different parties within different types of the business. We've been trying to get that information out real time. I think what's a little bit different, I've been in Newmark 35 years, and obviously we've lived through the crisis in 92, 93. We lived through a crisis in 97, 98. We lived through 9/11. Is that there were kind of endpoints to those periods where you kind of had real data, you looked at it from an economic perspective. The troubling thing that we've been challenged with is looking at endpoints to this event. And so it's really looking at it from the perspective of, from the endpoint, what happens. And we do believe that, there is a positive outlook once we get to that endpoint. I don't know whether that endpoint is a vaccine or a proper treatment for COVID-19, but coming out of it, there were some cracks in the fundamentals to the marketplace. And they were starting to show. Mark talked a little bit about it as it related to WeWork, and there were certain things happening within the market that were starting to show signs of erosion in the market. But overall, the market was in a good place. When we start to look at coming out of this, do we believe in the work from home model? Do we believe that that is the future of New York City office or global office? Maybe for some people, but I think by and large, the reason why people go to work is beyond just working, is being part of an ecosystem, being part of a collaborative work environment, being part of an ethos and a culture that you can't get from working from home. So when we looked at people talking and we put out surveys and their response, only 10% of the people really do have a desire to work from home. Most people have a desire to be in a workplace. So we still believe in the future of the workplace. We still believe that there are opportunities to grow the real estate market, but it is going to be a little bit of a tough sled for the next 12 to 24 months as we start to reopen these marketplaces. So there are 3 markets that are reopening really right now: Florida, Georgia, and Texas. And there'll be pretty interesting test cases to how the business economy comes back in those marketplaces. A lot of other cities are behind that, but we certainly in New York are trying to take a lot of direction from our Asia offices in terms of how they went through the reboarding process and reopening their markets. So we're optimistic as a company, for sure.
Very, very good. All right, Chris, what's your perspective?
Thanks, Barbara. And just to maybe tie some threads together from Mark, Chad, and what Brian suggested, agree with all and everything that they've been saying. My perspective comes from ensuring that our over 100 global enterprise clients and ensuring that they're getting the service that they need to help them through these times. And as you can imagine, the questions are coming fast and furious. I'll tie into three key remarks or marks that I think were touched on. The first is remote work is here and we proved it works and it's here to stay. The question is, though, per each enterprise, how much of it is the right fit to their culture and their business? So where we think we're going to see a pivot is how many people and where those people work, which gets into really great questions about where do you find talent and labor? And those are the kind of, do you do nearshoring, onshoring, of bringing footprint back here or close to the Americas? And that bodes well for Denver and the job market, I think, because we are prime given the type of demographics we have that make up the city right now. So that's one key point. I think that remote work's here to stay and that we're going to have to advise clients on how to integrate that. Sort of, you hear the term own the wallet, we're using the term own the home, right? So how do you advise clients on who and how people should stay at home? So that's one key point. The second I want to get back to is liquidity, and companies are going to need cash. And what we're helping companies think through is monetizing their assets. So either looking for semi-synthetic or sale leaseback types of opportunities to generate cash. Then there's a second bucket that's saying, look, we got to shed cost. So really looking at ways of advising clients on how to rationalize or optimize their footprint. And a lot of these kind of conversations tie together, obviously. And then the third, I'll talk about sort of the state of transactions that we're seeing in deal flow on a global basis. Brian had mentioned APAC and Asia and what's happened there. That obviously stalled. For a lot of our larger projects, we are seeing them continue, but what I would say caution. The ones that are implemented in the sort of execution and finalized stage, we're moving forward and completing those. The ones that are in the beginning period or on pause, they're not canceled. So I think as we emerge out of this, we're going to see sort of a charge forward in the second half of the year, starting to see that deal flow pick up. Not many have really canceled, which is a good thing, but they are, we are questioning what is the project given what we're seeing from both the workplace and the direction from where the future business is going.